Anybody is more than welcome to pay more taxes if they want.
Maximizing the law to your benefit. Who doesn't do that?
Take advantage of the code.
Our government has two mechanisms for influencing what we do.
The government cannot give something it has not taken.
Part of the tax code that says, hey, if you hire an employee, the money that you pay the employee, you can deduct from the revenue as an expense.
So the government doesn't produce, they redistribute.
How many deductions did they decide to leave off their tax return and say, you know what, I don't need these deductions. I'm not even going to claim them.
How could somebody set themselves up like a Buffett who pays very low taxes, or Trump who didn't pay taxes, or Amazon? Hey everyone, welcome to another episode of the Market Disruptors Show. Today I am sitting down with Jeff Socha. He is the CEO and the founder of ARC Financial. ARC Financial does tax strategy and basically figures out how to make you more money by having to send less to your partner at the government. I've known Jeff for a while. We've talked a lot about taxes, which is a boring but yet exciting subject. I'm excited to jump in with you today. Jeff, thanks so much for joining us.
Hey, Mark, thanks for having me on today. It's a real pleasure.
Yeah, so taxes is a horrible subject to talk about, but I actually think it's a good subject to talk about, and it's definitely a worthwhile one. And we've had many conversations about it, so I'm excited to have you on. But for those that don't know who you are, just give us a little bit of a background on kind of what you do with tax strategy and kind of what you're doing right now.
Yeah, sure. So I'm not sure how much of the bio you want. So the quick rundown is just that I grew up in a third generation family owned business where I heard taxes complained about a lot. And had an opportunity to lobby for a couple of political action committees on tax legislation. And then, of course, started this firm and went to business school at Harvard, and have just really wanted to try to drive value to people where they don't have to pay more than they have to. I mean, there's enough financial challenges and hurdles in us accomplishing our goals. And how are you going to accomplish your financial goals? You've got to maximize your income and minimize your expenses. So you create as much wealth and margin and buffer and discretion as you possibly can. And taxes just happen to be one of the biggest expenses, and it's complicated and it's confusing. And if you're major Fortune 500 company and you have a big four firm putting a ton of resources into planning your taxes, the Apple tax plan that has been praised and scrutinized depending on who you are, that takes a lot of resources to come up with something like that.
Yeah.
And so for the average successful person who is looking for help, but can't necessarily access the same team that a company like Apple would, that's the people I want to help.
Yeah, great. That's so much. You said something. You said they don't have to pay more than they have to, and I love that. And I want to dig into that just for a minute. So we hear a lot, especially recently, that these big corporations, these big rich people, whatever, these greedy business people, whatever, they don't pay their fair share of taxes. But you just said they don't have to pay more than they have to. They're saying they don't pay their fair share. How do you see that?
Yeah, I mean, it's kind of like when talking about Apple, when Tim Cook had to go testify to Congress, and they're beating him up over taxes, and he said, "Look, our company is the number one taxpayer in the United States at the time, and I think fair share is relative. I think that there's a tax system, there's a lot of code, there are options, there are mechanisms in the code to incentivize people, and utilizing the code to your benefit is something that everyone is entitled to do. And I think anything beyond paying what you have to per the code is just no different than charity. And if the government is your charity of choice, then so be it. But a lot of people I know might choose a different charity. So I think everybody that gets scrutinized, as long as they're doing it legally. I mean, look, the people who don't do it legally, they have a world of hurt and a world of problems, and they're in tax court and they're dealing with real issues. But just because you don't like the effective tax rate of some individual or company, if what they're doing is legal, then if you don't like it, whose fault is that? That's not their fault for taking advantage of the code. It's the people that wrote the code that you should take your problem up with. If you want tax law to be different, tax law starts with Congress and then it gets regulated by the IRS. So if you want that to look different, it starts with who you vote into Congress. So
Yeah.
I don't know. It's like that old saying: "Don't hate the player, hate the game." Right?
Yeah.
So, if you don't like the rules of the game, well, the individuals and the companies are not the ones making the rule. So, don't hate them for not donating to the government.
Yeah. Yeah. A couple things in there. First of all, for everybody who's listening, we're going to get to some pretty juicy stuff that I'm sure you're going to want to hear about. We're going to dig into Amazon and Bezos, how they're not paying taxes. We're going to dig into a little bit of the Trump tax returns that just came out and talk about that. We're going to talk about Biden and versus Trump tax policy, what that might mean in this election. And maybe you need to be selling some assets right now. And then I'm going to have Jeff give us some advice on how we can save some money on taxes, whether you're business or self-employed. So just make sure you stay tuned for all that. But back into what you just said here, you talked about one thing you said, first of all, is that you don't have to pay any more than you have to. And I love the fact that anybody is more than welcome to pay more taxes if they want. So you said if they don't like the policy, they can, of course, change it, but they could also just pay more as well, right?
Yeah.
So there's that. And then you also said one other thing that I want to ask you about. You said, take advantage of the code. And so I think a lot of people see that as ooh, they're taking advantage. They're using what they say loopholes. They're finding legal ways to not pay. They're loopholes or they're taking advantage. But I don't really see it that way. Do you see it that way, or is there a different way to frame that?
So maybe we should talk about a law that's not tax as an example. If a lot of the highways in Texas have 75-mile-an-hour speed limits. So if I want to drive and set my cruise control at 75 miles an hour so that I can get from wherever I'm going as fast as the law allows me, is there anything wrong in doing that versus driving 70 or 65 and saying, well, if you drove 55, Jeff, it might be safer. The law says I can drive 75. So why would I not drive 75 miles an hour if I want to?
Right.
Now, if I drove 80 and you had a problem with it, okay, that I understand. There's a regulation there for a reason. But for someone to get upset because you're, maximizing the law to your benefit, who doesn't do that? We all do that.
Right. Yeah, that's a good way to look at it. I love to put things in different perspective. That helps out. I've also kind of looked at it as the government, I've often said, I've tweeted this, that the government cannot give something it has not taken. So the government doesn't produce, they redistribute, right? So the government has a set of policies that they want to push, whether that's full employment, whether that's housing. And so they can't do that. They can't make full employment. They can't provide housing. So they need people to do that. And so a new administration has this policy, and then they use tax policy to help incentivize people to do that. Would that be a right way to look at that?
Yeah. If you think about it, domestically, our government has two mechanisms for influencing what we do. Mm-hmm. They have taxes and they have prison. So,
okay. The carrot and the stick.
Yeah, exactly. So prison is there for the things they don't want you to do. If you break certain rules, the penalty is prison, right? So taxes are actually used as an incentive to get you to do things. Prison is used to get you to not do things. So taxes aren't necessarily there to say, don't, you don't have an income tax to say, don't produce an income.
Right.
So when you have a benefit, you could take very basic part of the tax code that says, hey, if you hire an employee, the money that you pay the employee, you can deduct from the revenue as an expense. and you don't have to pay taxes on the revenues spent on employees. Well, the incentive there is go hire employees,
Right.
right? So if you go and buy real estate to provide a place for work or housing, and the government says, hey, we're going to give you write-offs for that real estate, they're saying, please go build or provide real estate for housing and work.
Right.
So, I mean, let's just talk about one tax deduction that I imagine COVID will probably change forever.
Okay.
The red flag that so many people talk about, I can't tell you how many times I've heard a CPA or somebody say, oh, the home office deduction is a red flag. Well, think about it. COVID,
Oh,
like
yeah.
how many people are working from home? Like who's not going to claim the home office deduction this year?
Right.
Right? Like, why would anyone? I mean, everybody's been working from home for the most part, at least to some extent. So even if you're, regardless of your employment status, if you're working from home, you're not going to take it because why? Because you didn't
Right.
take it last year? Because, I don't know. So I think for anybody that wants to necessarily complain about the code and somebody necessarily using all the deductions available in the code, I think they need to look in the mirror and ask themselves, how much extra did they pay to the government? How many deductions did they decide to leave off their tax return and say, you know what, I don't need these deductions. I'm not even going to claim them.
Right. Yeah, that's a good way to do that. Yeah, I think, so do you think then, is it smart, or do you think most people should probably look at what the government policies are, what they're trying to do, and then align their own goals with the government? Like you're almost working together, like in partnership?
I mean, whether you want the government as your partner or not, I don't know that anybody would necessarily want them as an active partner, but they definitely feel like a silent partner, getting a
Yeah.
share of the income and profits. And so, there's the tax code, which is the rules around how much they get.
Yeah.
And to not know the rules, I think, is just not being a good fiduciary. So if you're running a business and you're providing for families and income and for all these things, why would you not know the rules?
Right.
So if there was a tax deduction or a tax credit available and you're not taking it, I mean, why would you do that?
Yeah, exactly. Yeah, I mean, it all goes back to, like you said, not paying any more than you have to. You're more than welcome to, but you don't have to. And that's where I see people, even Bernie Sanders got caught in this because he's pushing to increase taxes. And they're like, well, you made whatever millions of dollars off your book. Did you pay more? He's like, no.
Yeah.
Um, so why would he? But let's talk about a little bit about, we hear about like Amazon that hasn't been paying taxes, or again, these rich people don't pay their taxes, or now Trump, his some stuff came out, his tax plan, or I'm sorry, his tax returns, where they say he hasn't been paying taxes. So what kind of a situation happens with a Bezos, an Amazon, or a Trump, where they could be a millionaire, billionaire, and not pay taxes? I mean, that's totally possible and legal, right?
Your net worth has nothing to do with how much you pay in tax. How much
Okay.
you pay in tax has to do with your income. Okay, that you have income taxes, which can be ordinary from earned income, or capital gains or passive income from maybe the sale of an asset or something like that, an investment. And then you have estate taxes. Now, I hate estate taxes because the government's taxing something they've already taxed, and I don't like the double tax.
Right.
So for all of the ongoing income taxes, look, no, I don't think anybody's getting away with not paying their taxes. If if you owe taxes to the IRS and you don't pay, the IRS has processes in place to come after you to collect that money.
Right.
You can file liens. They can seize your assets. They can. They have a lot of authority to be able to come and collect. Okay, it's not a collections agency that you want to mess around with.
Right.
And I think they know that, and so that fear that people have of them being a really fierce collector is what they use to get the compliance, which
Yeah.
is not a bad thing. I mean, like we want people to comply, but look, if Bezos or somebody like that owed $1 billion in taxes, he would be in tax court. The IRS and potentially even other government agencies would be coming after them to do whatever they had to do to seize assets and collect the tax. So, I think instead of looking at those people and saying they should pay more in tax, I think we should maybe look at them and try to learn how they're using the laws, the rules to their advantage to build a business without the drag of unnecessary taxes.
Yeah. So that's a great point. So let's talk about that. So how could somebody set themselves up like a Buffett who pays very low taxes, or Trump who didn't pay taxes, or Amazon? What are some things that people could do? Maybe we want to break that down into business owner and non-business owner, or business owner, investor, non-business owner. How would we think about that?
Well, yeah, let's start with the non-business owner, non-investor. Hey, I just have W-2 income. Unfortunately, that's the category that gets picked on the most.
Mhm.
So when you have W-2 income, there's not a whole lot you can do if that's your only source of income. So you're going to pay tax. You're going to pay tax for the payroll system. And most of the tax advantages that you have are in your qualified plans like 401ks and IRAs and things like that that allow you to defer taxes or have the gains be tax free if it's a Roth. You can save money into life insurance that has great tax advantages. So there's different ways that as the W-2 income earner saves and invests, that they can save and invest in a tax advantage way. With the new tax law, their state and local taxes are limited to 10,000 deduction, but everybody gets a good standard deduction of 12,000 now. Uh, and then aside from that, you've got charitable. So you could have charitable deductions, and you could lump charitable deductions every 2 or 3 years to get bigger deductions, and you can kind of manage it in a different way. But those people really have the least amount of options. So it is really important that when they save and invest, they're thinking about the future and how to compound things in a tax-free environment. So like, investing in real estate, investing in tax qualified plans, et cetera.
So you're
So
saying that because they're W-2, they're getting their money and their taxes are already being taken out in advance. And there's no way they can really write off any of that income because they don't have any expenses against that income. So
right.
basically their full income is coming in and it's just being taxed at full pop. And there's really not much they can do about it. The only thing that they can do is change the way they take whatever money they've earned and grow it, and they can affect the way that that's taxed.
Yeah, and you can get some deductions from saving into your 401k or an IRA, things like that. So, how you save and what you do in the world of philanthropy and charity, those things. But most of the advantages in the tax code are geared to business ownership and real estate. I have two theories on that.
Yeah.
There's nothing more than theories. One is that those are the people that provide housing and jobs. The other is that most of the people in Congress come from families who own businesses in real estate. So I don't know which way it is, but those are the two theories I have on it.
Well, I would say going back to where we originally started, right? The government has these policies that they're trying to push forward. Obviously, we know getting back to employment is a big one. And so, of course,
Right,
if you create a business and create jobs, there's a tax incentive. And so I
right.
think I just think when people realign their vision with that, it makes sense. But anyway, go ahead.
So I think the next category that's a little easier to address is the investor category. So you brought up Buffett. I'm not intimately familiar with Buffett's finances, but from reading his quotes and things that he puts out, the thing about his taxes and why he says his taxes are low is because he's very much a buy and hold investor. He invests long term, right? His mantra is find companies that have value, and now granted he's such a big investor, he can get great investment opportunities and deals.
Hmm.
And so when he gets these great investments and he holds them long term, it's no different than if that W-2 individual buys a home, right? Say they buy a home for whatever, 200,000, 500,000, however much it is. And let's say that home appreciates for $100,000. They're not paying tax on that $100,000 of appreciation. And in fact, when they sell that home, there's tax laws that allow them to recognize that gain without paying tax.
Hmm.
So, if Buffett invests in Coca-Cola and holds it forever and his stock goes up, I don't know, 1,000% or something fantastic over time, he's not recognizing that until he sells.
Right.
Right. So I don't think he sells a lot. He's not a day trader. I don't think he's a very active trader. I think he looks for long-term, high quality valued investments and places them. And so I think for most investors, if you follow that kind of mantra, you're going to get the same benefit. You don't pay tax on appreciation until you sell it.
Right.
And then there's tax loss harvesting, where you just think, okay, if I'm going to realize some appreciation, maybe I should also look to cut some dead weight in the same year. So sell off some bad ones that I've been hoping would turn around and haven't, take those losses, have those losses offset some of my gains that I'm also going to realize. And so you kind of have those mechanisms. But if you invest in things like businesses and real estate, now you're opening up all of the tax advantages of business and real estate and investing in those. So if you move into that realm of owning a business and owning real estate, I mean, the tax code is just full of deductions and opportunities to invest and reinvest and make different decisions on how you want to manage the finances of your real estate and your business in a way that's really efficient from a tax standpoint.
Yeah. And I guess if anybody's read Rich Dad Poor Dad, I mean, he kind of draws that out with the 4 quadrants, going from the employee to the small business owner, and then investor. And the business owner and the investor is where those tax breaks are. So most of the people, I think, that watch this channel and tune in are investors, because we typically talk about, stock market, gold, Bitcoin, things like that. So as an investor, is there certain things that I should be looking at doing with my investments to maximize that? Like, should I be investing through a corporation? Should I look at, trying to sell every year? Should I try to do it through some sort of a deferred plan? What kind of strategies would I use?
Yeah. So I think if you're not going to be a day trader, which I'm not, I think that's a high risk game that some people are successful at. I don't have that skill. But again, if you're going to be a long-term investor, think about the tax treatment of where you hold that investment. So, if you've been able to save into tax qualified accounts like IRAs or Roth IRAs or 401ks, different types of things like that, those come with tax advantages that allow for more active trading where you're not recognizing the gains. I think outside of that, you have to really look at understanding what your cost basis in investments is, so that when you have, big movements in the market like we've had this year, you have opportunities to take losses. And I think what happens with individual investors a lot is they get so emotionally attached to an investment that they don't ever want to, cut their losses.
Right.
And so they never want to take the losses. And the term for it is just tax loss harvesting. Google tax loss harvesting, and you can probably find all the reading you want for days on tax loss harvesting, which is nothing other than saying, I'm going to take losses to offset gains in a strategic way where it's timed to, minimize my tax liability.
Okay. Now, you did talk about, we've talked about 401k, you've talked about IRA, Roth IRA, tax deferred plans, tax-free plans. Is there an overview that you can give us of those and how those should be used, the differences of tax deferred versus tax-free growth or whatever?
Yeah. So the age-old argument there is, do you want to tax the seed or tax the harvest, right? And so, if I'm going to max out a 401k and I'm going to put $20,000 into it this year, I'm getting that $20,000 deduction today. But then let's say fast forward and I'm 60 years old and I want to cash that out, that $20,000 might have grown to 50,000 or 100,000 or whatever. I'm going to be paying tax on that entire amount. So I got a deduction on 20, and let's say it grew to, I don't know, 50. I'm paying tax on 50, right?
Right.
The flip side of that is pay the tax now and invest in things like a Roth IRA or insurance contracts that allow you to build cash value that have similar tax treatment to a Roth IRA, which is you're using money that I'm paying tax on the 20 grand today. So that might look like I have $15,000 after tax. So I have 15,000 to invest instead of 20. But I put that 15 grand in there, and that 15 grand, let's say it grows to, I don't know, 45 or whatever, or 40,000. But I can take that 40,000 out and I don't pay any tax,
Right.
right? So it might not grow the same to 50, but I don't have to pay tax when I take it out. So I paid tax today on the 20 instead of tax later on the, 40 or 50 or whatever it grew to.
Yeah.
So, those are pretty much the main vehicles that people have to invest in. In some corporations, you have deferred compensation plans and executive compensation plans that allow for greater deferral of income than just maybe a 401k would, or and if you don't have a retirement plan, then you're limited to a much smaller amount and a pre-tax IRA, traditional IRA that gives you a deduction versus a Roth IRA, which would be like where you pay the tax today. So those are pretty much the options you have there.
It seems like if we go back to the last 100 years of history in the country, the debt has only grown higher and higher and higher. The taxes have bobbled up and down a little bit, but for the most part seem to always be going up as well. When you look at the amount of debt that we're adding, it seems like the tax rate is going to have to go up. So to me, it seems like it'd be a better idea to pay the tax up front today, knowing what we have versus waiting until the future. Do you see that? Or do you think some people just want to roll the dice?
I mean, having the crystal ball on where taxes will be in the future, to me, feels like having the crystal ball on which stock to buy and when to sell.
Mm-hmm.
If you look at the history of tax rates, I mean, first of all, it wasn't, let's see, much more than 100 years ago that we didn't even have income tax.
Right.
So since the introduction of income tax, which, caused a big riot when it was rolled out, I think it was about 40 years ago, somewhere around 1980. I think the highest tax rate was around 70%, something like that. You can look up the history of tax rates. You can find some interesting charts. So, if you think from kind of prior to Reagan being president, having a 70% tax rate, to George W. being president, having a 35% top rate, you go, okay, well, geez, that got cut by half in 30 years. So it has been low. It is lower. It has been higher. It would seem like in the future, they're going to have to raise taxes because the government simply cannot afford what they're spending.
Right.
So, the challenge the government has, and from my limited exposure to government, it seems like the number one concern of the politicians is getting reelected. And, then number two and below is policy concerns. So getting reelected, when you go and you start cutting benefits, whether it's unemployment or welfare or Social Security or Medicaid or whatever, you start cutting benefits, it's not very popular in the voter base, and you can lose voters, which means you can lose your reelection. So the government isn't that excited about cutting those things because they don't want to lose votes. They don't want to lose their reelection.
Right.
But we don't have enough money to pay for it all. So something's got to give. We could continue going in debt, but I think even that's gonna break down at some point. So what we've been doing is we've said, you know what, we'll just keep the programs going without increasing taxes. Instead of increasing taxes, we'll just increase debt. But those are basically the three tools. They're using debt, tax, and spending.
Right.
So you can cut spending, you can raise taxes, or you can take on debt, or some combination. So politics drives a lot of this. I mean, the 2018 tax law change, Tax Cuts and Job Act, that got put through effective the beginning of 18, I think is one of the most significant tax changes since Reagan
Wow.
administration. And I mean, it's incredibly significant. And but you could have significant change the other way. So
Right.
I mean, who knows? Who knows?
Yeah.
We'll see where it goes. I mean, we've had look at estate tax when people die. The estate tax exemption not that long ago, I forget what year it was only $600,000, and everything over $600,000 was taxed at something around 50%. Now it's like 12 million, and it's taxed at 40%.
Mm.
So, but there was a time period one year randomly under George Bush where I think it was 2012. If you died in 2012, there was zero estate tax.
Wow.
So things in tax are just like anything else in government. I think it's hard to predict, and it can change a lot.
Yeah, for sure. I think, as an investor, you would kind of look at like the pricing through a channel, and there's kind of like the high and the low prices. And so if you kind of looked at taxes in the same, you might see that we've had very high taxes, as you pointed out, 70%, very low taxes. And right now we're more on the lower end. So just from that perspective, it seems like we're on the lower end. So why not pay the lower end? But
as much as people hate their taxes right now, I mean, take yourself back to, I don't know. I mean, I wasn't an adult thinking about these things, but back in 1980, and you talk to people about getting a home loan that costs like, 15% mortgage interest rate and 70% highest tax rate. I mean, and we think we have it bad now with 37% and 4% mortgage. I mean, half of what things were a couple generations ago.
Yeah.
And so, I mean, I don't think Americans are very great at keeping history in context.
Right. Yeah. You need to.
So I mean, think like 2008 wasn't that long ago, and people just got nailed. And what have people done since then? I mean, we've had like one of the greatest bull market economies ever. And are people like flush? Are all their retirement accounts full? Are their bank accounts full? Are people just sitting on hordes of cash? I mean,
certainly not.
Some are, but I don't think the majority are.
Yeah.
Why not? Why not? Like, if you couldn't save a lot of money in the last 10 years, are you ever going to? And I mean, is the problem the economy or the tax rate, or is it your behavioral psychology?
It's all that. You talked about, politicians not wanting to lose elections. And of course, we're heading into a very big election here in about a month and a half, 2 months. And I want to dig into that a little bit and talk about the implications in taxes in regards to those two things. Before we do that, I just want to jump into one other thing that you brought up, or I should say it sparked a question. And I know this might be a little bit outside your expertise, but what we're seeing now is this push towards a new monetary policy called MMT, like modern monetary theory, right? Where basically we can just print as much money as we want. The debt doesn't matter. We'll use taxes to drain the money out of the economy if the inflation rate goes too high. We're really seeing this already, I think, starting to be put into place, and a big push for that. The question that people have, including myself, is that if they can just print as much money as they want. So I think since this pandemic, they've printed like $6 trillion.
Crazy.
The amount of tax revenue is about 3 trillion or something. So they've printed about double what the annual tax revenue is. So why collect tax revenue at all? Do you have an answer for that?
I haven't thought about that, but I think that that's a pretty interesting question on why collect taxes at all if we could just live on debt forever. I think the reality is that we can't live on debt forever. At some point, I think right now and for a while, the United States, really since about World War II, has been the dominant financial powerhouse in the world. and we're able to have the US dollar as the world reserve currency. And right now, there's not another country that can really replace that.
Right.
But I mean, the rest of the world might decide one day that us just living on debt from all the other countries is something they don't want to put up with anymore,
Yep.
and find a way to replace the US as the world reserve currency, which would change the world as we know it. And I think that keeping the debt in check is probably something that we have to do to maintain that position. So I don't imagine a world of no income tax. I also think that income tax, uh, the government likes control, and the same way we were talking about the carrot and the stick earlier, income tax policy provides a way for politicians to kind of reward certain groups or provide benefits or provide incentives or influence. And I don't really see government wanting to give up that ability to influence behavior and the economy.
Yeah. That's a
So
good point.
I mean, that's a pretty out there question about
Yeah.
like, why don't we just borrow money from other people forever? Not, I don't think that's sustainable. I hadn't
Well,
thought through like how exactly that would unfold, but I don't
it's
think it's
certainly not sustainable, and I think you gave a great answer actually, and I hadn't really thought about that. And it is the carrot and the stick, and so they need to push policy, and so they use taxes for that, and so without taxes they give up that control, and so I think that actually makes good sense. It's a good answer. Um, it's one I
right.
think a lot of people are going to be asking as we continue down this path of printing.
Yeah, I mean, and the path of printing money like this, that can't go on. I mean, um, I, we'll never know, but I sure wonder how the United States government would have reacted if, let's say, all of the incumbents were reelected and COVID happened in 2021. I doubt that it would have been the same government response that we saw this year.
Sure.
Because and I also think that's why, I think there's a lot of money on the sidelines waiting to see how the elections go, because I think if you have let's say if all the kind of status quo incumbency transfers over, you're going to see this kind of probably a government that doesn't feel, at least the presidential administration, not concerned about reelection.
Right.
And if we have a real big changeover, who the hell knows? All bets are off, I guess.
Yeah. Well, let's talk about that changeover then. So, obviously we already have the incumbent, Trump is there, and we have this tax plan, which, as you said, was maybe one of the biggest tax changes we've seen since the 80s. But then we have the challenger, Biden, coming in. And so he's kind of already kind of given us what he thinks is his tax plan that'll be moving forward. He's come out and said that he wants to raise cap gains. From what is it, about 23% at the top up to about 39.6, so about 40%. That's a big one. Per the analysis done at the Tax Foundation, they say that up to 39% and above 1 million, it would eliminate the step up in basis for cap gains taxation. So that's a big change. That's a really big change to cap gains. What kind of effects do you think we would see from that?
Well, I think we'd have a lot of negative effects. I think it would be the people that would benefit would be the all of the tax planning firms in the country.
Sure.
You have a lot of people
Always.
with asset sales that are trying to figure out how to reduce the pain of that change. But I mean, you have to think about, first of all, what are capital gains? So capital gains are gains on the sale of an asset. And so what does that mean? That means the sale of an investment, like a real estate investment, a business investment, other investments. So, if you go and you say, let's just say, hey, we're going to make the capital gains the same tax rate as ordinary income, the discount on capital gains tax is an incentive to invest, right? They're saying if you successfully invest, you invest in business, real estate, stocks, whatever, and you make money doing it, we're not going to tax you as much as we would from, you and I going out and working for a paycheck.
Right.
Now, whether that's right or not, I don't know, but the discount is there to incentivize investment.
Right.
So when you say, hey, we're going to tax that as much as, let's say, ordinary income rates, for example, which right now the top is 37 for federal. If you're going to say, hey, let's tax it like that, it removes the incentive a little bit from investing. But I think that the counter argument to that is, okay, if you have money to invest and the tax law changes, are you just going to sit on it and bury it in the backyard? I think people are still going to invest. I don't think it's going to say, well, I'm going to not invest because of the taxes. Like, I think what it does is it makes it harder for every American to get ahead financially, because whether you're that W-2 income earner or investor or business owner or real estate person, investing is the way that you have to compound the money that you're able to save to provide for your future.
Yeah.
And so all it does is eat away at the compounding.
Yeah, just to give a little bit of a frame to this for those that aren't really familiar with what we're talking about. So you have earned income that you're working for, and then you have your investment income or capital gains income. And the thing is that from my perspective is that I've already had to earn the income, and I already had to pay taxes on the earned income. Then after taxes, I take the money that I have left over, and then I decide to invest it, and then I got to pay tax again. I've already paid taxes. So it's that double taxation. So it seems to make sense. Again, with the incentive, the carrot and the stick, they're incentivizing us to invest because companies need investment capital and so forth. So I've earned it, I've paid taxes, and now I invest it. Why not get a little break on that? It makes sense. So that gives them some frame. But let me give you a couple stats that I looked up. So we've seen cap gains increase. Well, I have two different instances. So Reagan signed a cap gains increase in 1986. And when the cap gains increase happened, within 10 months, the S&P actually went up 30%. Interesting. And then also in 2013, Congress passed a cap gains increase, and the S&P ended up the year 30% higher. Now, that might be causation, not correlation, I should say, not causation, but that was some interesting facts. But I've also seen that a firm an advisory firm in Chicago was saying that they've been converting conventional IRAs to Roth IRAs to figure out the taxes. So from a tax planning perspective, if we see cap gains potentially going, almost doubling, really, would it make sense? Would some people want to think like maybe I should take cap gains now on some of these things? Maybe not my best assets, things like that. Should we? You talked about harvesting losses. Should we think about harvesting gains in a low tax environment before that goes through?
Yeah, it's hard to know. I mean, we're trying to predict the future of what Congress, who will be in Congress and what kind of laws they will create and how those laws will be enacted.
Well, Biden says he's going to raise it to 40%. So we kind of have his word on that, right?
Yeah, but that's not something a president can do alone.
Okay.
So, it requires Congress to get on board with that and to create the law. So, president, I don't think there's a precedent for a president using some executive order to change tax law. So, while he might push for that, whether or not he gets it, I don't know. So predicting tax law is kind of like predicting any other investment. It's really hard to do. I think that I do think that taking money off the table when the time is right. I mean, look, if for no other reason, the market's been amazing for 10 years. So, it doesn't last forever.
Right.
So you should definitely consider taking some gains and pocketing some gains and recouping your initial investment, taking some chips off the table. And I don't think that letting the tax tail wag the dog is the right thing to do. I mean, if it makes sense to capture some gains and take them off, take them off risk, then do it. I don't think being full on risk all the time is the smartest way to manage your money. So
Definitely not.
I think tax law is going to change. It's going to continue changing, just like all the laws continue changing. And so to me, I think that what we try to do is take the law that we have, make the most out of it, make the best decisions we can with what we have. So like when we're here in calendar year 2020, let's make the moves that we need to make based on the current tax law. And in 2021, if we get a new tax law, we'll have to make different decisions.
Yeah.
But
Okay.
Definitely, I think that would have a huge impact on how people invest. And maybe it would make them not want to sell as often. Maybe people would hold investments longer. I don't know. Maybe that's why the markets went up during those time periods, because maybe people thought, well, the hell with selling, I'll just let it ride because
Right.
I don't want to pay the tax. So maybe maybe it reduced selling. Like what I would want to look at in those years is what happened to the volume, the trading volume, and
Right.
see what happened there.
Yeah, some interesting points. Well, we've gone a long time now, so I really appreciate what you've done and giving us that time. Now, you are a tax strategy firm, so you're not really a CPA, a tax attorney. You just figure out how to reduce people's taxes. Of course, the old saying is a penny saved is a penny earned, right? So the easiest way to get a pay increase is to cut your expenses, and so that's what you help people do. What types of people do you like to work with? Like what, like income levels, or what kind of income types?
Yeah, sure. I would say that most of the clients I work with are in the top tax bracket. Most of them are entrepreneurs, business owners, private companies. And like I said earlier, that's where most of the advantages are. So, you get most of the tax code is available to you. And so they just have the most planning opportunities. So I think it's where we can make the biggest impact. And when you're making an impact against money being taxed at the highest rate, that impact is most valuable in those income ranges. So.
Great. Well, again, Jeff is from ARC Financial. I will make sure to link to it in the show notes down below. Is there anywhere else that people should follow you, keep up with you, or is that the best place?
Yeah, I mean, you can check us out I think we're on all the variety of social channels. If you want to follow me personally, I launched jeffsoha.com if you want to look me up there. But regardless, feel free to reach out in whatever form or fashion you like.
Yeah. Well, good stuff, Jeff. Thank you so much for taking the time. And that's it. See you.
Thanks, Mark.